What is up, YouTube? This is the Working Investor. In this video, we're going to revisit the Defiance in the money put that they do with the whopping return. And we're going to compare that to ROUNDHILL's synthetic covered call ETFs on the indices. And we'll talk about pros and cons and reconsiderations and a new way to look at it, because I spoke to many investors and there's more than one way to view an asset, and there are different things matter more for different people. So number one, when you have we're going to call it the Defiance products, which is IWMY, QQQY, or WDTE, which is going to be the new name for JEPI. And these funds are in the money cash secure put or synthetic puts, so synthetic cover puts, that could be, it's flexible. It's usually short term, either daily or within the week or less. And because it's in the money and it's a put, and there's something called put skew, most of the time puts are more richer if you compare delta to delta. People like to buy insurance so their underlying doesn't drop. Puts, you do get more premium out of it. So let's talk, and then there is the ROUNDHILL products, and the ROUNDHILL products are out of the money or at the money or close to at the money synthetic cover calls, and there's differences in the strategy, right? So let's look at a diagram over here. Let's look at the Russell 2000, right? Because these products we're talking about three indexes. We're talking about the S&P 500, we're talking about the NASDAQ 100, and we're talking about the Russell 2000, three major US indexes, right? So let's look at the Russell 2000, for example, and let's talk about, for example, doing trading options. Let's do, selling a put. So let's say you want to do selling a put. I mean, the market's actually already closed. Let's do selling a put for tomorrow. So you could see here the Russell 2000 IWM is trading at 217.88 just after market hours. So let's say you want to sell. So an in the money put means that it's in the money. So let's say we're doing a 218 cash secure put, right? So it's in the money, right? It's right at just slightly ever so in the money. So you can collect $1 per share, and there's 100 shares per contract. So you can make $100, and basically, you will be put the shares. You could see here very, very clearly, this is a neutral to bullish move. If the market goes up, then we're doing amazing. You get this crazy premium of, of like $100 or 97. It's moving around. You make almost $100 for one contract, and if the market goes up, you're golden. If it goes down, then you're not doing so well. So this is a neutral to really bullish strategy. So that's what it is, because you're already starting in the money. So let's look at the same scenario. Let's do sell call. And now we're doing an out of the money or at the money cover call. So let's say we're doing even a 219 call. So it's out of the money, right? It's a little bit out of the money. It's a 0.31 delta, right, for tomorrow. So you're receiving maybe half the premium. You can see here, right? So now this is a strategy that's not bullish. This is more of a neutral to bearish strategy. That means if the market stays neutral, doesn't really move up or down much, or the market goes down, by having this premium on for the covered call, you will beat the market. So in a neutral to down market, having covered calls, you will outperform the market. When you have puts on an upward market, you will do very well. There's a YouTuber out there. He's called Invest with Henry, and he has over 3 million in one of his portfolios that he shares. And I've been watching his videos for quite some time, and one of the things that he attributes to his success is running very aggressive, at the money or puts or like slightly out of the money puts on Tesla. And when Tesla was in an uproar, so he just kept throwing, writing puts, writing puts, writing puts, and it just kept going up and up and up, and he just kept collecting these massive premiums because he barely was assigned. That's what I imagine. But he talks about that Tesla writing aggressive puts, cash secure puts on Tesla, has been a big catapult to his success. I'm sure there are many other things. So I want to show you that these strategies are different, right? Again, the roundhill products will outperform the market when the market is neutral or going down. It will do better than the market. And then let's go again, trade options tomorrow. We'll do sell put, and we'll do it in the money put. That's what the Defiance in the money put products run. And they will do very well if you look at the diagram. Not if the market is neutral or goes up, then you get max profit, and they would not do so well if you go down. So I think to myself sometimes, looking at this premium, going back to the premium of Roundhill, right? And I look at IWMY because IWMY has the most compelling premium of, almost 110, 111%, give or take, depending how you look at it. That is crazy, crazy, crazy high. But of course, there is, the net asset value does obviously go down. The question is, does the premium that you collect, does it outpace the IWMY? Look over here. Does it outpace the drop in net asset value? Because if you go back over the past year, you see it dropped, overall from inception till now, just about, 39%. But if they claim to give an annualized return of 110, 111, you far outperform the drop in net asset value. And then there are two ways of thinking about, speaking to investors. There's two ways to think about an asset, these high yield performing assets. One way of looking at them is total returns, right? Which means that, how much premium did you get, and then subtract how much you lost in value of your underlying, and then you can calculate your total return. Maybe you want to adjust it for taxes and other expenses. So there's something called total return. And then you see this truck here. Some people look at these assets like an ROI play, return on investment play. Like when you buy a truck, a work truck, to do a job, you're running a business and you buy this truck, you understand that a vehicle in general is a depreciating asset. You understand it's going to go down and down and down in value to the point where it's worth 1% at the end of what you paid for it. Well, why would you buy this truck? Because you don't buy the truck because of the resale value of the truck. You buy the truck because the truck is going to do a job for you, and hopefully the business that it's going to bring in will pay for the truck multiple times over. You may pay $100,000 for the truck, but the truck is going to bring you $1 million of revenue and maybe $500,000 in net profit. Who cares? So you have a truck that's worth now, over many years and lots of work, it's worth, a couple grand. Who cares? Because it did what it's supposed to do. So a lot of investors say they understand that these products, they go down, they wither, they decay, but the ROI is far outpacing, the return. Now, like I did quick math yesterday. I mean, it may not be perfectly accurate because this was yesterday based on numbers from yesterday. So JEPI, which is the S&P 500, which I mentioned, it's going to be called the WDTE. These are all Defiance products. Specifically, I call these the Defiance in the money put funds, right? So it had a 72%, if you look at the website, overall return, and it dropped about 26% as of yesterday in net asset value. The QQQY, which is the NASDAQ, it supposedly gives you 105% return, and it dropped as of yesterday. The numbers are off 40% roughly. I rounded it close to the closest number. So your net total return of JEPI is 46%, of QQQY is 65%, and IWMY, as you just saw, 110, 111, let's just say 110 to be safe. And we said it was like, we saw today, it was about 39% loss in value. Let's just say 40 just to be round, be a little bit on the conservative side. So let's say total return from a total return standpoint perspective, it's about 70%. I just wanted to plug in actual numbers and actual dividends received. Excuse me. So on 12/1/2023, as far when I look back at on the chart, I think I saw IWMY trading around $59.72. I calculated dividends received over, I think it was since that time, since December. I have to go back further to really calculate because I think they've been around since September, October, somewhere in that range. But since December, they've paid out $32, and I added them all up, and 49 cents. And the price today is, let's say, around 36.85. It's, of course, moving up and down a little bit. So let's just say 59.72. Let's subtract 36.85. So 59, let's go to the calculator. 59.72 minus, let's take away the price today, see how much it dropped. 36.85. 36.85. So it dropped $22.87 loss in net asset value since December. So that's about 10 months. And then let's subtract, but you did receive dividends. So let's subtract the 32.49, 32.49. So that means you actually received total of, after you account for the loss in value, you got $9.62 extra left over. So if you take $9.62 left over, you divide it by your initial investment, and this again is not, these funds, if I were to go into these funds, and I'm thinking about it back and forth, if I should or not, if it's right for me or not. The reason why I'm thinking about it is because, as I showed you in the example, with the ROUNDHILL products, it's covered calls, so it's more it's neutral to bearish play. With the, if you think the market's in an uproar, then these may be at some point possibly something you may want to think about. Again, I'm not a financial advisor. Do your own judgment, do your own research, speak to your financial advisor, speak to your accountant, lawyer, professor, whoever you need to speak to. So yeah, so let's finish up the thought. So $9.62 divided by the trading price of 59.72, 59.72. So that comes about 16% return. Let's divide it by 10 months because it's divided by 10 months. It's a 10-month return, right? So multiply by 100. So that's 1.61% per month. Multiply that by 12 months. That comes out to be after 19.33% net annualized return after you're accounting for depreciation from your initial assets. Considering that you never put a single dollar into it. But obviously, I would possibly play it is, buying in. I think you would probably have to buy in, I would imagine, every single distribution to, lower your cost basis consistently, and try to keep your value stable. So your actual cost basis may be coming lower to market price. And if you think about it, that if you're getting 110-ish% total return, roughly, I mean, not total return, but distributions, and it's not falling down by 110%, negative number, if you put in 10 grand, theoretically, you would get like 11 grand, back. So you can literally DCA in very nicely, almost 100%, and lower your cost basis over and over and over again. And one thing I wanted to bring to your attention, and I'm thinking about it too, and if you have different thoughts, I'd like to hear your thoughts. I'd like to hear different perspectives. I always think that we all have different blind spots, and the more eyes on the product, you may notice something that I don't notice. I may notice something you don't notice. So the more eyes on deck, the better. When you see here that IWMY, we're calculating, I don't know, we're calculating that if you take away the value that it dropped, you got 70%. That's on year one. Or if actually plugging in real numbers, you saw that it was like 20%. That's on year one. But what happens on year two when you receive now another time your entire ROI. You get another 110% or 100%, or if it varies, 90%, whatever. What happens on year 3 when that happens again? Eventually theoretically, I mean, we have to see how this plays out. Time will tell, but maybe you may end up getting 3-4 times back your initial investment over multiple years. You may have an infinite return. So that's something to think about that I've seen a lot of investors talk about. People are worried about reverse splits, and listening to the hedge fund managers, of course, you want to hear other people, you want to hear third parties, but they say, reverse splits are really just cosmetic because the SEC requires, certain. I think you can trade it on certain brokers if it's less than a certain value, or it's once a stock gets below, I think around $10, they have to start thinking of reverse splitting it. And the way Jay talks about it, he's one of the fund managers of IWMY, and he's involved with Defiance. He says that a reverse split is like basically, taking if you have if you have two $10 bills, and then they take that away and give you a $20 bill. Now you have less bills in your pocket, but you still have the same value. You know what I mean? So when something reverse splits, you still have, theoretically, that's what he claims, you'll have triple the theoretical dividend amount. I also want to, so just something to think about, just something to further think about. Just I did a post today about the distributions. Today is Declaration Day. Today is the day everybody was waiting for to find out what Roundhill's new product RDTE is going to be paying. And they're going to be paying around 30, where is it? I saw it somewhere, 36 cents. I'm just sorry I'm making you dizzy here. Here you can see, 36 cents per share. It was a little bit anticlimactic because I was thinking that it's based off of 2.5 weeks of trading. I was expecting a little bit more, but that's what they claim, it's going to be. The XDTE was, if I'm not mistaken, about 18 cents, 18.8 cents. And then the QDTE was about, I think it was 25 cents. I did post it on YouTube, on the community. Anyways, so what do you guys think? This is the Working Investor over and out. I hope you guys have a wonderful day. If you have any thoughts and input on this, let me know.